So my job is relocating me and I need to purchase a home. So if you're in that situation, by the end of this video, you're gonna have a great understanding of how to make that happen. Getting relocated by your job or voluntarily relocating seems to be getting more and more common, and relocating adds an important wrinkle when qualifying for a home loan. So whether your current job is relocating you to a different part of the country, or maybe you're starting a new job altogether, this video is gonna help you understand the process and get you on the right track to achieving your goal of buying a new home. So welcome back to the channel. My name is Gavin Sessions with Loans Made Simple. And if you're curious to learn about all things related to mortgage and home loans, subscribe to our channel. We post new content each week. If you're ready to get qualified for a home loan or you're looking to get connected to a great real estate agent, our contact information is in the description below. So in today's video, we'll basically review what it takes to qualify for a home loan, but we're gonna do it through the lens of relocation. And then we'll conclude with 3 common scenarios. So we've already done a couple other videos about home loan qualification, and we'll point you to those at the end. But just in case this is your first time watching the channel, we want to do a quick review of qualification. So recall that home loan qualification is most simply a review of your income, your assets, and your credit report. And since it's likely that relocation probably won't have much of an impact on your assets or your credit report, we're going to touch base on those first, get them out of the way, and then we'll focus the majority of our time on how relocation affects your income. So recall that assets are money in the bank to cover your down payment and your closing costs in a real estate transaction. So most of the time, assets are gonna come from savings over time or from the sale of another home or potentially the sale of another asset like a car. So the most important thing to note is that all assets need to be deposited to a bank account at least 60 days prior to using them in a real estate transaction, and that's called seasoning. But there is a very common exception to that rule. So when you sell a home, the title or escrow company will provide you a final settlement statement. And when you sell a car or something else of value, you should provide the buyer of that item with a bill of sale or something similar. And providing those types of documents to the underwriter will allow you to use those assets sooner than the 60-day seasoning process. It's called sourcing the deposit. All right, let's quickly move into a recap of the credit report. So credit reports get a bad rap, but they don't need to be scary. It's simply a comprehensive list of your liabilities and their associated monthly payments, as well as 3 credit scores from the 3 credit bureaus, which are TransUnion, Equifax, and Experian. And those 3 credit scores are simply a performance metric for how you utilize credit historically. All right, so the most common types of accounts you're gonna see on your credit report are gonna be credit cards, auto loans, student loans, mortgages, and each of those accounts will show a minimum monthly payment. All right, so shifting back to credit scores, they're gonna range from non-existent, 0, in other words, you've never established credit before, up to a score of potentially 850 plus. And higher credit scores typically mean lower account balances and a clean payment history, as well as accounts that have existed for a longer period of time. And on the flip side, lower credit scores typically mean higher account balances, maybe later missed payments, shorter account history, and possibly even collections or charge-offs. So to be approved for a mortgage, we're typically gonna be looking for a target minimum credit score of at least 620, but there are a few loan programs that allow for lower credit scores. And if your scores are on the lower side, it's typically best to get connected with a credit repair expert, and we've got great people on our team that can help with that. So to kind of wrap up that section, by and large, higher credit scores mean favorable loan terms and a higher likelihood of being approved for a mortgage. So we've briefly discussed assets and credit report, and before we discuss how relocation affects income, let's do a brief overview of what income actually is. Income is very simply how you get paid, and underwriters care most that your income is both stable and continuous. An income that is confirmed to be both stable and continuous is considered to be qualifying income, and that's an important term to note. So you might be asking, how do we define stable and continuous? Well, stable means that we're able to document a 2-year history of receipt, ideally in a similar line of work with minimal gaps in employment. And continuous means there's no defined end date for your employment. All right, most people earn their income as a W-2 employee of a company, and they're paid either hourly, salary, or commission. And their income is typically documented with regular pay stubs and an annual W-2 report. So as I mentioned earlier, we've got a couple other videos that are gonna more thoroughly explain additional income types in case maybe you're self-employed or retired. Hey, it's Gavin here. Just wanted to take a second. If you're ready to take the next step on a purchase or refinance, click the link below, fill out our form, and we'll get you connected to our pre-qualification team. All right, so we've reviewed how to qualify for a home loan, focusing on assets, a credit report, and income, but the question was relocation. So let's focus a bit on how relocation affects your income, which will affect your ability to buy a house. All right, here's the first scenario. You're a W-2 employee of company 123, and you've worked for that company for the past 2+ years, and your boss just now informs you that they're planning to relocate you from California to Texas. So to keep this scenario as broad as possible, let's say you're either paid an annual salary or as a full-time hourly employee, and both of those pay types are gonna be sufficient for this scenario. And one of the benefits you learn is that you're going to receive a 10% raise if you accept this relocation to Texas. All right, so let's assume that you accept the offer to move to Texas, which makes this an ideal situation, assuming that your goal is to immediately buy a home in Texas. All right, so recall that qualifying income must be both stable and continuous. So salary is the most stable of any income type, and that's because your pay is not going to fluctuate regardless of the number of hours you work each week. But being paid full-time hourly will work as well because you're continuing to work for the same company even though it's in a new state. So your income is continuous as you're not a contract worker with a defined end date. Likely the only additional required documentation in this case is a signed offer letter from Company 123 on their letterhead, which confirms your new position in Texas, your start date, and your new annual salary or hourly rate. Okay, so before we move on to the next scenario, let's add one common wrinkle. What if you're planning to work remotely rather than in a company office or a location? So the only additional documentation likely needed in this case would be a letter from your employer confirming that you are approved to work remotely. All right, let's get into scenario 2. You're a full-time W-2 employee of retailer XYZ, and you've worked there for the past 2+ years, and you decide, hey, it's time to relocate from Indiana to Florida because you want to be closer to your family. And I've heard those Indiana winters can be rough. All right, so your current employer pays you full-time hourly and you're planning to find a new retail job in Florida, ideally making the same or even more money per hour. All right, so for a new hourly job in Florida in the same line of work, the underwriter will almost certainly require that you start your job prior to purchasing a home, and they will likely require that you provide at least 30 days of pay stubs to prove that your new hours are both stable and consistent. All right, so as underwriters are always concerned with hourly fluctuating income, it's kind of like a swear word in our industry. We can often mitigate that risk by providing them a letter from your new employer with a guaranteed minimum number of hours per week. All right, and as you've already worked 2+ years in the same industry, there should be little concern with starting a new job in that same line of work, but you may have to explain a gap in your employment if it takes you more than a few weeks to get moved down to Florida. All right, so this new job in Florida would also provide you income that would be continuous as you're not a contract worker with a defined end date. All right, let's jump into our third scenario here. You're a full-time W-2 employee. You're a salesperson at an auto dealership. In other words, you sell cars. And you've been doing that for the past 2+ years. And you decide now it's time to relocate from a smaller market in Oregon to a larger market in Idaho. And your intention is to stay in the same line of work. So the key difference here is you're paid as a commissioned salesperson. You don't receive a salary and you don't receive an hourly wage. So I'm beating the drum here, but recall that qualifying income must be both stable and continuous. And for commission income to be considered stable and continuous, you typically have to have received it for at least the past 24 months. But there are some exceptions where a receipt for as little as 12 months might be sufficient. All right, so if you're able to relocate and transfer within the same company, in other words, keep your same job, then the underwriter would likely require an offer letter from the employer which includes language about the expected stability of your commission income in the new market. And that letter would most likely allow your commission income in the new market to be considered qualifying and immediately usable to help you purchase a home. Let's say you're unable to transfer within the company, or maybe you don't want to stay with the same company. So let's say you take a new job selling cars at a new company in this new market in Idaho, and then the underwriter would most likely require for you to reestablish your commission income in the new market for at least a minimum period of 3 to 6 months. That means you wouldn't be able to buy a house right away, so you'd need to come up with some sort of interim short-term housing while you reestablished your commission in that new market. So upon hearing that from the underwriter, you might argue that you're an experienced salesperson in your field, and you'd be right, but the difference is you wouldn't be able to prove that you can have success in this new market without at least 3 to 6 months of sales under your belt. All right, so we could keep these scenarios going all day long, but if we didn't get to yours specifically, leave us a comment and we'll get an answer to you ASAP. All right, so hopefully now you've got a really good understanding of how relocation affects your ability to buy a home. And if you're watching this video, you're most likely in the market to purchase a home. If you're ready to buy or refinance, click the link in the description below to reach out to us. And I encourage you to go watch these additional videos, and they will further explain the home loan qualification process and will certainly help continue you in your education of the home buying process.